Hey, Triple S members, Kevin Chow here. Well, welcome to another session of the Chow Line. And just as a reminder, the objective of the Chow Line is to create a social media platform dedicated to supporting the prosperity of you, Triple S members, and your businesses. Is we're going to try to do this through engagement, recorded fireside chats, and the Chow Line will feature industry experts, members, and suppliers discussing best practices, innovative strategies, and emerging trends. This platform aims to foster knowledge sharing and promote collaborative growth and equip you, our members, with actionable insights to enhance your operations and achieve sustainable success within the industry. So today, our theme is going to be evaluating strategic alternatives, a roadmap for independent distribution. And I'm so excited about this session because we're going to focus on mergers and acquisitions, and specifically guiding you through how to position yourself as a janitorial distribution company for a successful sale or acquisition. Our goal is to empower you with insights and options so that you can achieve the retirement and legacy goals that you envision on your terms. So I'm really excited to introduce Michael Josephs. Michael, welcome to the Chow Line.
Thanks, Kevin. Great to be here with you.
I'm looking forward to it. So let me just share a little bit about your background, then maybe you can add to it. So Michael brings a unique blend of financial discipline, strategic thinking, and operational leadership to the conversation. He's currently the Executive Vice President, Chief Financial Officer of Spruce Industries, a proud Triple S member and family-owned Jansan distributor based in New Jersey. Now, prior to joining Spruce in 2023, Michael led business development and M&A for Town Square Media, a publicly traded company where he oversaw over 35 acquisitions and joint ventures over a 10-year span. His experience also includes 16 years as an investment banker, advising large cap companies on mergers and acquisitions and financial strategies. But now back in the Jansan world, Michael brings both Wall Street savvy and Main Street relevance, perfectly positioning to help our members, you, think about how you're going to build the value for your company and transition with purpose. But outside of work, Michael enjoys golf, tennis, and spending time with his family, and currently celebrating his daughter's freshman year at the University of Michigan. Okay, of course, of University of Michigan.
Well, Blue,
So please join me in welcoming Michael Josephs, and we're so grateful to have you, Michael.
thanks, Kevin. It's a pleasure to be here, and it's been one of the best things about coming back into this business and getting to meet you and the rest of the Triple S team and really all my colleagues around the country. And that's honestly how we think of Triple S is a big family, an extension of our family, and it's really been remarkable.
That's great. That's great. So, I covered most of your background. Is there anything that you want to add before we get started here?
No, I mean, I think you covered it pretty well. I think of it as this is the third stage of my career. So the first stage was being an investment banker, truly learning the skills and the craft and the trade, how to value businesses, how to raise capital for businesses, how to prepare companies for sale, how to help companies execute acquisitions. So on both sides as an advisor. The second chapter of the career was, as you said, at Town Square Media, which is a publicly traded company, where I was a principal and executing a strategy, a roll-up strategy, not dissimilar to what has been experienced, what we have all experienced here in the Jansan world over the last several years. I mean, doing 35 or 40 acquisitions, it should sound familiar to a lot of people listening to this. And then the third stage here, finally coming home back to the business that's been in my family for over 40 years. And honestly, the only exposure I had to this business previously was twofold. Once when I was in high school, like my daughter is now, and I used to make deliveries, and I wasn't the best at that. And my dad said, I think it's time for you to go to college. And then over the last, I would say, 5 or 6 years prior to joining, given all the consolidation in the space, I had a lot of very candid conversations with my brother and my dad about what should they do with Spruce. And because like you all listening, they get approached all the time when you have a successful business in a geography that's attractive, you're going to have people knocking on your door. So really, I was that outside voice, even though it was inside my family, but I was the outside voice trying to help them think through the variable and the various alternatives.
Well, that's why I'm so excited to have you here because I think you've got a lot of really good insight to share. Matter of fact, if you don't mind, Michael, what I'd like to do is before we get in the question and answer portion, I'd like to share some information and context to this subject that I've kind of done a little bit of research on and why this matters to distributors, right, or to our members, right? So if you think about the Jansan distribution industry, it's highly fragmented. Most of our firms are probably in under $10 million in annual revenue or so. And this creates an active M&A opportunity both for strategic buyers looking to scale, of course, but for also many owners considering an exit strategy, right? And driving, forces right now, of course, include a lot of private equity roll-ups. Um, and so, one of the things that we all know is that all of our members are family owned, right? Yet many of us do not have a good succession plan or have not necessarily prepared for that, or their businesses are their 401ks or their retirement programs, right? And so when you look at the demographics of our industries, the U.S. Census Bureau states that over half of the U.S. small businesses owners are age 55 or older, right? We all know that, us baby boomers, of course. And then so that's that's a big part of it. But in the Jansan distribution industries, we don't have any actual data, but we do believe that it's pretty solid where most owners fall between the 50 and 65-year-old range, often planning or needing to plan the next steps of exit strategy, right? So, I guess what I'd like to do is I'd like to help our members understand that there's more options beyond selling to private equity. We've seen a lot lately where that many have gone to private equity, and that's what they feel is the only path that's valid because distributors believe that no other independents could afford their business, which is not true. And private equity is not the only path and often is not the best path.
Mhm.
And so what I'd like us to be able to do today is talk a little bit more about, selling to strategic buyers, other distributors, supply chain partners, where our members can preserve their company culture, their customer relations, and employee continuity, right? And then also there's other ways such as inside succession planning, whether it be selling to family, of course, or even to the employees where there's some major tax benefits. And then also, what are the partial sale rollover equity situations where it could be monetized, where the investment may actually retain upsides in other opportunities that might be more beneficial for our members. So if that's okay with you, that's what I'd hope we could kind of get out of today. Does that sound good?
Yeah, absolutely, absolutely. They're all the statistics you cite. I certainly agree with, and we see that day in and day out in this industry. And if you look back over the last couple of years, that the massive consolidation we've seen here, and for some of us, we think that's a huge opportunity to go grab market share.
Right.
Think about what happens when companies in your geography get consolidated and the dislocation that happens with customers. So there's opportunities on both sides depending on where you are and what your stated objectives are. And for everyone listening, they're different. So
Yep.
each case is specific to who you are, your situation, your geography, your succession plan. And so you're going to hear a lot of it depends, and because that's not just banker speak, it's reality. Because
Right, right.
there's no cookie cutter answer to any of this.
Well, and Michael, I think that's a really good point because when I look at it and I admire our members so much of their entrepreneurship and the families that have grown the business, they've built something valuable. And their business is more than just a set of financials. It's a legacy. It's a community anchor. It's the livelihood for their teams, right? And today, I hope that we can really kind of explore how alternative strategies could really help reward the hard work and honor the legacies that they have built and that the people who work in them can rely on it. So let's get started into that. That sound good?
It sounds great.
All right, perfect, perfect. So, you know, you shared a little bit about your background and experience working, of course, in independent distributions and mergers and acquisitions, et cetera. So, why is it important? Why do you believe it's important for independent distributors to proactively focus on their own strategic alternatives right now?
Well, I think one of the old adages is, when you're looking when you need cash, it's the worst time to actually look for cash. And the corollary is the best time to go look for cash is when you don't need it. So the best time to plan for an event, whether it's a sale or an acquisition, is right now. If you didn't do it before, the next best time is right now. Because if you don't know exactly what your objectives are, if you don't know what your strategy is, it quite literally is impossible to tell whether this offer that's been presented to you is better than the next alternative, or if that acquisition that you may be considering, it actually fits into your strategy. If you
Mhm.
haven't given the forethought to say, okay, here's where we are today, here's where we'd like to be in 2, 3, 4, 5 years. And as you said earlier, it's not just about a financial model. It's not just about what the numbers say, because you can make an Excel spreadsheet. Well, I know I can make an Excel spreadsheet look and say anything. But at the end of the day, it's really looking your partners, whether it's your family members or potential successors, in the eye to say, okay, this is realistic. This is where we think we can get to. This is what we can do on our own. This is what we can do in combination with somebody else. Or, you know what? This is the right time for us to sell. But if you haven't thought about it beforehand, before that's presented to you,
Right.
you become a deal taker as opposed to a deal maker. And you really want to be in the business. Like, you always want to have enough forethought put into it so you're not making decisions under pressure, because these are complicated, they're emotional. You have put your heart and soul into building something. And, it's to make a sound financial decision, you need to be able to remove the emotion.
Mhm.
And if you haven't thought about what your clear objectives are beforehand, it's going to be really, really hard to do it at that time.
Perfect. So let's talk about that now. Let's talk about that. So let's just talk about preparing to sell, right? So what would you say are the key financial, operational, and cultural factors that a distributor should evaluate when preparing their business for sale?
So, not to be flip about it, but I would say it's the same exact metrics that you look at every single day to run your business. Like, what do you think are the most important things in running an independent Janssen distributor? What's my revenue growth? What's my revenue velocity? What's my customer growth? What's my customer velocity? What's my share of wallet? Do I have too much concentration with one customer? Do I have too much concentration in one vertical or one end market? Those are all things from a financial perspective. Yes, gross margins are important. Operational margins are important. Cash flow, obviously, is important. Understanding key components, well, you should understand your whole balance sheet, but key components of your balance sheet, because that all sort of shapes the overall picture. But when thinking about selling, I've always said to when I was an advisor, it's the same thing as running your business. Like, you don't want to make short-term decisions just to make this quarter look better, because guess what? It's not going to be there next quarter. And someone who's buying you is looking for that continued growth and that sustained growth. So when I think about it, when we think about it here, and when I've thought about it in the past, it's always, all right, what the business that I'm running today, what makes that a good business? And if
Mhm.
those KPIs that you think about it on a daily, weekly, monthly basis are all up and to the right, that's a good thing. And that's what any buyer is going to be looking at. So,
Right.
so run your business the way you run your business like you're going to own it for the next 100 years, and think about those financial metrics. Where do I invest? How do I invest? How do I continue to diversify my business such that it is attractive, whether I'm owning it, or somebody else is going to own it?
Good point. Good point. So I mean, we talk about finances and KPIs and all that side, but from your experience, what would you say makes a distributor's business most attractive to a buyer, especially like another independent distributor?
Yeah. I think you touched on this at the beginning, which is relationships. So it's relationships with your customers, it's relationships with your vendor partners, it's relationships and the team and organization that you built. Our most valuable asset walks in and out the door every single day. Forget about what's in our warehouse, because there are thousands of companies around the country who have the same stock in their warehouse at all. Not all of it says triple S on it, but it's the people, it's the relationships, and it's that expertise that you as an independent distributor bring to the table every single day. So when thinking about it, is there some unique market access that you have? Do you have a lock on the K through 12, schools in your market? Do you have a lock on the food processing industry in your segment, in your sort of geography? And if you think about, um, again, having the that rubric in mind of what fits and what doesn't fit, that's the way my mind thinks. When we're thinking about a potential acquisition, it's okay. Where are we in food processing? Is that something we should build? Is that something we should buy? So we're, penetrating that market today. So again, if someone is thinking about down the road, what's going to make Spruce attractive? Well, they've got broad diversification. They've got strong customers in each of these verticals that they're continuing to grow with. So it's about the relationships, at the end of the day, that truly differentiate.
That's a good point because oftentimes, you, I've seen in some companies who've acquired a lot of other companies that their cultures did not blend well, and it really caused quite a bit of havoc and actually a lot of disruption in a lot of ways. So,
Well,
and
we're
then
we're sorry, Kevin. I mean, we're seeing that today, and that's actually, we believe it's to our benefit, because
Mhm,
there has been such consolidation in our market, specifically in sort of Jersey, New York, Pennsylvania, this area, and um, quite literally, customers don't even know who their reps are anymore,
mhm,
and the reps are sort of forced to work with people that they've been competing with for years. They're forced to sell products they don't believe in, and
mhm.
they're frustrated. So that frustration sort of doubles and triples when you think about the end customer perspective.
Right, right.
So we hear it and we see it all day long, and to us, it's a benefit, but it's something to think about. If you're anything like us, which I'm sure you are, because or again, all family businesses, your team, your team members, your employees are extensions of your family, and it is important, and it would be important to us to make sure everyone is taken care of, not just the family.
Absolutely.
So that's really important.
No, and that's a good point because we've seen it where companies have literally been kind of destroyed because of that situation. So, with all of that, Michael, when you see that, what are some of the common mistakes that owners make before when they're preparing their business for sale, and how can they avoid them?
I think the biggest thing that I've seen, and it's not necessarily industry specific, because this goes through my whole career in thinking about whether advising or actually going through acquisitions. It's short-term thinking.
Mhm.
It's making decisions that, they think they're gonna outsmart you as a buyer, and pull a fast one. So, take the example of home ownership. So you've got two exactly the same houses, four-bedroom house, four-bedroom house. One has a brand new roof and one has a 50-year-old roof. Which one do you think is worth more?
Right.
Now, the guy who's going to buy the home with the old roof is not going to pay as much, because they're going to have to put a new roof on that house.
Right.
So
Good
I
analogy.
I really think about just that sort of avoiding being myopic and really just, as I said earlier, run your business like you're going to own it for the next 100 years, and you're going to make the right decisions for you as well as for any future owners. So that's what I think is the big real red flag that I see.
I like the analogy though, because that's actually pretty simple to think about, right? I mean, same house, which is very similar to our businesses, right? Just with a different roof or newer roof, right? So, so, so from an owner standpoint, let's just say, as you know, I'm at that age, anyways, of where if I had independent distribution company, I'm baby boomer, probably ready to retire pretty soon. You know, how far in advance should I, as a distributor, realistically start preparing for sale if they want to maximize value?
It's really hard to put a specific sort of time frame on it. I would go back to what I said earlier, which is if you haven't had this real heart to heart, or even if it's just with yourself, thinking about it, putting it down on paper, what are my objectives?
Hmm.
Now's the time to do it. Because one day someone's going to come knock on your door. If you're running a successful business, someone's going to come knocking on your door and say, "Hey, Kevin, I'd love to buy that business that you've built." Because I can see you may want to think about, the next chapter of your life, and we'd be a great, steward of what you've built. Now's the time to do it. And what I would say is, one can never, you can't really predict the market, and you can't outsmart the market. So don't try to time it. Don't say, "Oh, great, here comes the next COVID, and I'm going to hold on for that one more year, and the next year is going to be better." Um, as an entrepreneur, you always think the next year is going to be better because that's how you're wired. And so the trick is in negotiation, how do you get someone to pay you for that? But that's a whole nother discussion, possibly at a whole another time. But I wouldn't try and time the market. Don't think about, this is, it's a cyclical business and this is the end of the school year, the start of the school year, the beginning of the fiscal year. Don't worry about that because that all gets worked out in working capital mechanics and deal structure. Um, Start now, think about it now, so you're ready when someone knocks on your door.
So that's great. Let's go a little bit deeper in this. We've been talking about preparing ourselves for sales, right? And then we talked earlier a little bit about, private equity seems to be the most prevalent out there, and many distributors believe that that's really the only source out there. So maybe you can share with us why they should look at other alternatives, such as other distributors in the industry, other Triple S members, other partners, etc., versus private equity, or even employee-owned programs, right? Give me a scenario based upon your experience of why they should consider these other type of scenarios other than private equity.
I can look at the end of the day, each owner has to make his or her decision as to what he or she values most. And the bottom line may be, I want the person or group that's going to pay the highest price, period. For others, well, they're not mutually exclusive, but the other considerations are important. So who's best going to take care of my team and my staff that I've built and I've nurtured and I've trained all of these years to be great at what they do so I can look good? Secondly, who's going to take care of my customers? Because if you're anything like us, we actually have these long-term relationships where they are part of the extended family. For better
Mhm.
or worse, they're part of the extended family. And it actually matters who's going to service that customer because we want to make sure that they're taken care of and their end users are taken care of. And then does legacy matter? Does having your name on the door matter? And there are opportunities where that can continue. So I would say, based on how you value those various metrics and those various factors, that may lead you to, okay, a private equity backed buyer may be the best the best buyer for me. That's okay. That may be the case. Or maybe there's an independent distributor of a same size, maybe a little bit bigger, who has the financial wherewithal to take on what we have and what we've built and to continue to make it stronger. Maybe there's someone same size, maybe a little smaller, but they've got a team and a backing. Maybe it's from a traditional bank or it's some other source of capital to make it work for you to continue, if it's the name on the door or the name that you've built to grow and so it's not the big guy, but it's someone like that. And then, as you've said a couple of times here, an ESOP plan, an employee stock ownership program. Again, it's not right for everybody, but for some people, that's a viable alternative. And so, all I would do is I would encourage anyone who's thinking about it, avoid a bilateral discussion where you're only talking to one party. That is the surest way to leave money on the table. Again, if money is all you care about, you're definitely going to leave money on the table if you only talk to one party. So you don't have to run a 6 month long process. You don't have to hire bankers to call 1,000 people. There are ways to approach multiple buyers to give you a true sense of what the market is. Because what most people want to know is, I built this business for 20 years, 30 years, 40 years, 50 years. What's it worth? Well, the only way to know what it's worth is what a willing buyer and a willing seller agree to. And that's true fair market value.
Right,
So
right.
if you're only talking to one person, you're getting one perspective.
Great. And I guess I'd like to reemphasize what you stated there is that there's a lot of different scenarios out there other than private equity that can still financially be able to provide you not only a good value for the organization, but actually hold on to your legacy, your customers, and your people in a way that may be very important to you.
Yeah. I think there's highly structured deals where if you have someone that you want to succeed you, where you can you can lend them the money and they're basically paying you back over time. So
Mhm.
long as the company continues to perform, they're going to pay you back over time. So there's lots of ways to think about it where you can either preserve your income if you don't need a one-time lump sum payment. But I think at times sellers get too fixated on, well, what's that dollar number? What's that dollar number?
Right.
And there's so many other considerations. Yeah, money's important. That's why at the end of the day, we're all entrepreneurs and all capitalists, and we want to make as much money as possible. But we're building something, and
Mhm.
there's value in building in what you're building, and the team, and the people, and the process, and the relationships that you've built. So don't leave that on the table.
Good point. Good point. All right, so we've talked about preparing for selling. Let's talk about maybe I'm a distributor who's interested in actually in acquiring and growing. Matter of fact, we've just recently had some new members who actually acquired some other distributors out there also. So for members interested in acquiring another distributor, what initial considerations should they weigh before pursuing an opportunity?
So the single best thing that we did, this is at my last role at Town Square Media. We had a clear set of criteria when looking at an acquisition. It had to be in a certain region, a certain mileage, with a certain size. There were 7 or 8 items that if it didn't meet all 7 or 8, we weren't even going to look at it. Because
Okay,
part
yes.
of the issue is when you're in acquisition mode, you're sort of the hammer where everything looks like a nail. So everything you're going to say, yeah, that kind of fits. I'm going to make it fit. We're going to figure out a way to make it fit. That's the worst thing you can do because then you end up with a hodgepodge of stuff that doesn't necessarily do what you expected it to do. And you've
Hmm.
now veered off of your path, and your time and energy is now spent fixing those things that you could have avoided by just not making that acquisition. So have a very, very clear set of criteria that you're going to stick to and you're going to hold yourself to and you're going to hold each other accountable to, that this fits, this acquisition fits, and it's going to be a good one. So
So give me three or four, five pieces of criteria that acquirers would look for in terms of financial health, culture, and all that kind of stuff.
So I would say I'm going to put the financials aside for a second because I think we can talk about all of those, but they're similar to what we talked about before. But this is things like fit, like culture. So is the end market duplicative to where you are today? So that could be a good thing, right? So if you're already heavily servicing municipalities or transportation, and you want to double down in that market, and there's a good, strong, sound maybe it's one or two sellers that you're going to bring on that's going to really make the difference. Great, that may make a lot of sense as long as your customer concentration or end market concentration doesn't get worse. The flip side to that is if you're already strong in that segment, well, maybe I can go buy something complementary in another segment. So therefore, I've immediately diversified my
Mhm.
business. So end market, is there an overlap? There could be a good reason to do it. Is there no overlap? Which there could be a good reason to do it. Geography. I mean, at the end of the day, we are not necessarily interested in acquiring a company today in California. We're in New Jersey. There's very little operational synergies that we are going to yield to make it make sense. Now, there are times where it may make sense if you have a customer which opens a new facility in that market, may
Mhm.
make perfect sense. But again, as sort of that starting point of how am I evaluating an opportunity and does it pass the smell test if as it were.
Right, right.
That would be important for me at geography. And the third I think would be um, strength of relationships
Mhm.
that target company has. Now, oftentimes you don't really know. You don't know until, it's almost too late, because everyone's going to tell you they got great relationships, and then at the end of the day,
Right.
you may buy something, and that customer that you were counting on, they just disappear. So I think it's, geography, end market, customer relationship. That's how I think about those from a
Sure, sure.
non-financial perspective. On the financial side, it's all the things we talked about before. It's, seeing momentum in revenue, seeing good, solid operating leverage and margins, and positive cash flow dynamics where it sort of fits with your current business. A plus would be, listen, if you're super busy over the summer and you're sort of quiet, in the spring or in the fall, well, maybe you find something that's a little bit more accelerated in the spring or fall to even out that seasonality.
Okay.
So those are some of the financial things that I would think about.
All right. So with that though, then what would be some red flags that could signal or might signal that deal could be risky or maybe not a good fit, right?
I think customer concentration is one that I have always thought about, especially in this business where it is at the end of the day, it's still relationships. So if you've got one customer which is 30, 40, 50% of revenue, like that to me is a red flag. It's not insurmountable. It may be you're totally comfortable with that because the salesperson's gonna come with, and that relationship is secure, no problem. So that's one. Vendor reliance. Like, is there, a vendor that either you don't have access to or have had problems with in the past that the target is overly reliant on? That may be one red flag. And then the last one is, well, not the last one, but another one I would throw out there is um, like real cash flow. Like, do you really understand this target's cash flow and their working capital dynamics? Is it the same as yours? Is it different than yours?
Hmm.
And if it's different, you better understand why it's different and how it's going to work in how you currently finance your own business. Uh,
Good point.
so
Really good point. So kind of to wrap things up here, I've got kind of a three-pronged question, so it might be a lot, but I think it's time. First of all, a lot of great information. If a Triple S member is interested in either selling or acquiring, what professional resources would you recommend to bring them into the process? That's one. And then what would be maybe your final piece of advice to give to a Triple S member who is just thinking about selling or acquiring, and how could Triple S best support those members
Sure.
in any kind of transition?
Sure. So I would say there's a reason that investment bankers exist. There's a reason, tax professionals exist. There's a reason lawyers exist in our world. They all bring valuable insights and direction and can help guide you in what you're looking to do. The sort of caution I would bring is you know your business best, you know your company best. Don't blindly follow or listen to any of those advisors because they may not have your best. You may think they have your best interest at heart, but at the end of the day, you've got to be able to live with those decisions. They're going to move on to the next transaction.
Mhm.
But what I would say is certainly consult your tax advisors and accountants because there may be real tax ramifications depending on how long you've owned the business, the type of legal structure that you currently operate in. If you're an LLC or a C corp or an S corp, there are real potential tax implications and structuring alternatives once you get to a deal. But again, be prepared for those conversations and have those conversations before there's even a deal on the table to at least know some of the things that you want to have in the back of your mind and think about as you're evaluating a proposal. I think lawyers, to me, I bring lawyers in once you're at a term sheet stage or once you're thinking about either buying or selling. Um,
Mhm.
a smart business focused lawyer is not just going to run up fees. They're actually going to provide insights, and I know plenty of really good ones. Feel free to reach out, call. I'm happy to make recommendations. And then I do think that bankers, again, having grown up in that world, I think bankers are valuable, but you need to be able to direct them what to do because there are some bankers who literally will just take your documents and hand it to somebody else. They won't help you craft a story. They won't help you explain the nuances in your specific distribution business, which is different than mine. And it's understanding those differences, which is really going to be able to drive higher value. So I think there's value in bringing in a banker early to help you think about how they position you, who they might call on your behalf. Um, but you know, they can't tell you what your business is worth. They can give you a range. As I said earlier, only a willing buyer and a willing seller in a fair market is going to tell you what your business is worth.
Right,
So
right.
those are the professionals that I would certainly reach out to. In terms of Triple S and how Triple S can help, I said this to you, Kevin, after the first clean team that I went to 2 years ago, where it was the single best experience I've been from a professional conference meeting. People were so open and welcoming and willing to share and willing to talk about not just successes, but failures and
Mhm.
mistakes. I would say reach out to Kevin who can connect. I'm happy to talk to you. Just reach out to other people in this tremendous organization that we're all owners and members of, because there are so many people who have been through it before, either as a principal or as an advisor. And we don't compete with each other. That's the other beauty of it is we can share without really breaking too many confidences. So use the network, use this resource, which is hugely valuable.
Mhm.
And then the last thing I'd say is, you can pass along my contact information. Like, call me. I'm happy to help. I think not just whatever. It's just the way I was born and raised. Like I'm here to help, and I've got a lot of experience in this space. And we're excited. We at Spruce are excited about things we're looking at and things we're thinking about. But I'm happy to share because not everyone's situation is just like ours, right? We're unique, and so
Yeah.
are you. So I'm happy to be thoughtful about it. I now know just enough about this industry to provide a little bit of insight. But really, these are plays that are portable from industry to industry. So I've done it a number of times, and I'm happy to be of help where I can.
That's great, Michael. Really, truly appreciate your time, your energy, and your willingness to share your information and your experience with other members across the country. And I guess I'll just kind of wrap up with one last thought is that I want our members to just to realize and think about that there are other alternatives than private equity. There are other members out there or other distributors who can provide maybe what you're looking for regarding maintaining your customer base, maintaining your team members, etc., that could still provide you what you need for your nest egg for the future. Again, Michael, this was great. This was probably a fantastic conversation to have. I think it's going to be very valuable for our members. And all of you Triple S members out there, thank you. Thank you for being a Triple S members, and we'll see you next time on the Chow Line.